Welcome back to Investing Talk podcast.
Today we're looking at Exxon Mobil.
As usual, before we start, subscribe, like, and comment to this video to support the show. We really appreciate you tuning in. So, for you listening, when you think of a legacy oil major, you probably picture this sort of massive, slow-moving dinosaur.
Yeah, a behemoth just resting on its laurels.
Exactly. Just simply riding the unavoidable boom and bust waves of global commodity prices. But what we're looking at today, it shatters that preconception completely. The reality here is that this company is in the middle of a historic transformation.
They really are. They're turning themselves from a basic price taker into this highly efficient, honestly, virtually bulletproof cash flow machine.
And the sheer scale of the turnaround's what gets me. The trajectory they're on leading up to 2030 is staggering.
It is. We aren't looking at a company just, trying to tread water or maintain a legacy market share while the world transitions around it. What's happening here is it's a masterclass in structural efficiency and capital allocation.
And aggressive growth.
Right. Aggressive growth. The underlying data points to an incredible multi-year roadmap that completely redefines their earning power, regardless of what the broader macro environment throws at them.
Well, let's unpack the numbers and look at the fundamentals, because the financial foundation is where this transformation stops being just a corporate talking point and starts becoming undeniable math.
The math is where the story actually lives.
Yeah, and looking at the revenue and earnings trajectory, the headline numbers are massive. But I do need to play the skeptic here and challenge the core assumption.
Go for it.
They are projecting $25 billion in earnings growth from 2024 to 2030. That averages out to about a 13% annual earnings growth rate. But here's the kicker. That projection assumes constant prices and constant margins.
I know it sounds.
Wait, 13% growth assuming constant oil prices? In what world does crude stay constant for 6 years? That feels like a massive, almost naive assumption to build a $25 billion projection on.
It sounds totally counterintuitive for a commodity business, right? But that is actually the genius of their current strategy. They aren't relying on a massive spike in oil prices to hit this target at all.
Okay, then where's it coming from?
They're building a model where that 13% growth is generated entirely through internal efficiencies, scale, and shifting their product mix. It really comes down to two main drivers. The first is their upstream segment,
which is the actual exploration and production of oil and gas.
Exactly. They project over $14 billion in earnings growth here versus 2024. And it is heavily driven by the Permian Basin. They have optimized their extraction and operations so intensely that by 2030, their unit earnings, meaning the actual pure profit they make per barrel, is expected to jump past $15.
Let's pause on that for a second, because tripling unit earnings from their 2019 baseline is wild. To go from making roughly $5 a barrel to over $15 a barrel in a decade, that is pure operational leverage.
It's massive.
You don't get there just by turning the pumps on faster. That requires fundamentally changing how you operate.
Yeah, it requires changing the very DNA of the operations. It means hyper-efficient drilling times, massive supply chain consolidation, and shedding legacy, high-cost assets in favor of premium acreage.
But that upstream efficiency only accounts for $14 billion. Where's the rest?
Right, so $9 billion of the remaining earnings growth comes from their product solutions segment. This is the refining and chemical side of the business, where they take the raw hydrocarbons and turn them into finished materials.
And this is where the structural game changer comes in, I think. They're targeting $4 billion of growth just from what they call advantaged projects,
Which are the high-efficiency, lower-emission operations.
Yeah, and 60% of that $4 billion is already de-risked, meaning the startup projects are already underway or fully operational. But the standout detail here is a product line called Proxima.
Oh, Proxima is fascinating.
For you listening, Proxima is an advanced high-performance material technology they've developed that replaces traditional resins and materials in industrial applications like construction and automotive parts. It's lighter, stronger, and far more corrosion resistant.
And the reason Proxima matters so much to the bottom line is that it insulates them from crude oil price crashes.
How so?
Well, when you make advanced industrial resins, you are operating on a completely different demand curve than retail gasoline. Proxima systems alone make up over 40% of that product solution's earnings potential.
Wow.
By climbing up the value chain into these high-margin specialized materials, they are decoupling a massive chunk of their revenue from the daily fluctuations of the oil market.
It's basically a hedge built directly into their business model. But to execute a pivot of this magnitude, it requires serious capital, which brings us to their financial health. And I have to say, looking at the balance sheet, it is fortress-like.
It really is an anomaly in the sector.
They are carrying a net debt to EBITDA ratio of just 0.56x. In a notoriously capital-intensive industry where competitors frequently take on massive debt loads just to keep their rigs running.
Which usually hovers around the 2x or 3x mark.
Exactly. So having a ratio at basically half a turn of EBITDA means their balance sheet is virtually invincible.
That 0.56x leverage profile gives them the ultimate luxury in corporate finance, which is flexibility. It allows them to weather any macro storms without ever cutting the dividend, and it lets them aggressively reward shareholders.
And a huge component of how they achieved that immaculate balance sheet is their structural cost savings.
Yes, since 2019, they have stripped $20 billion out of their operating expenses permanently.
Let me ask you this, though. How does a legacy giant actually trim $20 billion in fat without damaging its core operations? You don't find that kind of money just by cutting back on corporate travel?
No. Absolutely not. You find it by entirely restructuring the organization. They centralized their procurement, meaning they leveraged their massive global scale to negotiate better rates for literally everything, from steel pipes to software.
Just buying in bulk at an unprecedented scale?
Right. And they digitize their supply chains. They're utilizing predictive maintenance on rigs so equipment doesn't break down unexpectedly, which saves millions in downtime. They merge disparate business units to eliminate duplicate corporate overhead.
And that $20 billion falls straight to the bottom line.
Straight to it, boosting profit margins across the board without requiring a single extra dollar of capital spending.
And those operational savings are exactly what funds their massive shareholder return program. They have $20 billion in share repurchases mapped out all the way through 2026.
Which is huge for investors.
For you as an investor, buying back that much stock shrinks the outstanding share count. It makes every remaining share you hold represent a larger slice of that massive profit pie. Plus, they're projecting a $35 billion growth in free cash flow from 2024 out to 2030.
That is cash left over after all the bills and capital expenditures are paid. We also have to factor in the Pioneer Natural Resources acquisition here, which is acting as a massive accelerant for all of this.
Yeah, the integration of Pioneer seems to have exceeded expectations on almost every single front.
It has. The synergies from that deal have actually doubled initial projections. They're reaching $4 billion annually.
To put that in perspective, think of this like a massive real estate developer buying up the last remaining premium lots in a booming, highly desirable neighborhood. By applying ExxonMobil's proprietary technology and massive logistics network to Pioneer's premium acreage, they just strip out the redundancies and maximize the output.
That real estate analogy is perfect.
And that $4 billion in synergies is directly funding their push to double their Permian Basin production to 2.5 million oil-equivalent barrels per day by 2030.
Because it brings us directly to their competitive moat.
Yeah.
They now control the largest and highest quality inventory in the entire Permian Basin.
Yeah.
But, owning the best land only matters if you have the best tools to extract the value from it.
Which brings us to their proprietary technology, specifically what they call lightweight proppant.
This is a huge advantage.
For those unfamiliar with the mechanics of hydraulic fracturing, proppant is usually a sand or ceramic material mixed with water. It gets pumped deep into the ground at high pressure to literally prop open the microfractures in the shale rock so the oil can flow out.
Right, but usually traditional sand can only travel so far into those cracks before it settles.
Exactly. So ExxonMobil engineered a proprietary lightweight version of this material that travels significantly deeper into the fracture networks.
And the result of that deeper penetration is a 20% improvement in oil recovery rates.
20%?
Yes. It is a staggering operational advantage. It means they get a fifth more oil out of the exact same, for roughly the exact same capital outlay. When you compare this capital efficiency to competitors like Chevron, ExxonMobil operates with significantly lower break-evens.
Which changes everything.
It does. In fact, their portfolio optimization is so aggressive that by 2030, 65% of their total production will come from what they classify as advantaged assets, meaning the absolute lowest cost of supply with the highest inherent profitability.
Okay, so it's one thing to have a fortress balance sheet and incredible internal efficiencies, but it's another to see the market actually reward it. Let's pivot to the charts and see how the market is pricing this in. because Wall Street is clearly taking notice.
The charts are showing absolute dominance right now. ExxonMobil is up 26% year-to-date and up 39% over the past 6 months alone.
39% for a mega-cap oil stock is wild.
It's not just a slow, steady defensive climb either. It's an aggressive, sustained, breakout signaling massive momentum heading into 2026.
Hold on, I need to emphasize a contextual stat here because it completely recontextualizes that breakout. ExxonMobil alone is responsible for 32% of the entire energy sector's 21% return.
Just let that sink in.
Think about the gravity of that. Almost a third of the entire energy market's growth is riding on the back of this one single stock. That is not just sector leadership. That is basically a monopoly on sector momentum.
And the institutional flow driving that momentum is heavily influenced by the macro environment. We're witnessing a major rotation of capital driven by geopolitical realities, specifically the significant escalation in the Iran conflict and the resulting surges in global oil prices.
Just looking at this purely through the lens of capital flow setting, all the complex politics of the Middle East, aside institutional money, is using this equity as a safe haven.
Exactly. It's a classic risk-off move.
When geopolitical tensions spike, you get that risk-off market environment. Money managers panic about broad market stability, so they pull their capital out of high-multiple speculative tech stocks and park it where cash flow is guaranteed. Historically, that means defense contractors and oil majors.
And ExxonMobil is catching a massive wave of this institutional inflow. They're acting as a fortified vault for nervous capital.
And compounding that macro tailwind is their company-specific operational execution.
Particularly in Guyana. Their offshore drilling projects in the region are progressing way ahead of schedule. So you have this beautiful technical setup, external geopolitical tailwinds pushing the entire sector up, combined with internal operational wins creating sustained, company-specific breakout potential on the charts.
But raw price action is just one side of the coin. Wall Street operates on narrative, and understanding how the street is digesting all of this data is crucial. Shifting gears to sentiment and how the street is viewing all of this, what are the trackers saying?
The quantitative sentiment data paints a very specific picture right now. There are two highly bullish narratives dominating the institutional conversation. First, as we just mentioned, is the Guyana growth story.
Right.
It's not just that they are finding oil down there, it's that they are consistently under budget, ahead of schedule, and repeatedly winning the ongoing legal tests and arbitration surrounding their rights in the region. The street loves certainty, and ExxonMobil is delivering it there.
And the second massive bullish narrative is their reputation as the ultimate dependable dividend aristocrat.
Oh, absolutely.
They are boasting a 3.48% dividend yield right now, backed by a track record of over 25 years of consistent payout history. In an inflationary environment where capital is volatile, institutional investors flock to that kind of unbreakable reliability. It's an anchor for a portfolio.
Yet, there is a fascinating paradox in the sentiment trackers regarding the broader macro news. The general headlines about the oil surges and the Iran disruptions are actually scoring as technically neutral on the algorithmic trackers.
Which is weird, right? At first glance, you would assume higher oil prices automatically equal bullish sentiment for an oil company.
You'd think so, but the trackers rate it neutral because it's a double-edged sword. Yes, an oil surge massively benefits ExxonMobil's bottom line in the immediate term. But simultaneously, $100 oil causes broader market anxiety.
Oh, I see. It reignites inflation fears.
Exactly, which makes the Federal Reserve hawkish, which threatens to slow down the entire global economy. It is fantastic for the company's cash flow, but terrible for the broader market's psychological health.
Looking ahead at analyst actions and the catalyst calendar, we are tracking major events that will force Wall Street to reconcile these numbers. The next major earnings report in late April 2026 will be critical.
Very critical. Analysts will be dissecting the numbers to ensure that the aggressive 13% earnings trajectory is maintaining its pace following the strong January results.
We're also closely watching the advancement of the Uaru and Whiptail projects in Guyana, and remember that lightweight proppant technology we discussed?
Yeah, the deep penetration tech.
They are scaling that rollout to 50% of their Permian Basin wells by the end of 2026. As that proprietary tech covers half of their most productive acreage, the efficiency gains will be mathematically undeniable.
And while we might not be seeing a flood of specific 2025 and beyond analyst upgrades flashing across the terminals today, the sheer math of their 2030 plan forces the issue.
It demands an upgrade eventually.
Right. As they hit these milestones, Analysts will have absolutely no choice but to make upward revisions to their long-term earnings and cash flow models. The current models simply don't fully price in the structural cost savings yet.
We also have to address the speculative rumors circulating the trading desks. The loudest unconfirmed chatter right now revolves around the Strait of Hormuz.
That's a huge potential catalyst.
It is one of the most critical global shipping choke points on the planet. If the conflict escalates and that strait faces a prolonged closure, we could see oil pushed rapidly to $100 a barrel or well beyond.
A closure of that magnitude triggers a 1970s-style supply shock. It would be highly disruptive to the global economy. But the financial mechanics heavily favor ExxonMobil.
Because of those low break-evens we talked about.
Exactly. Because their operational break-evens have been engineered to be so incredibly low, every single dollar that oil rises above their cost of supply falls straight to the bottom line as pure, unadulterated profit. Their massive scale means they capture that upside better than almost anyone else in the sector.
Okay, I hear all these catalysts, but I have to hit the brakes here. We can't just look at the upside. Let's lay out the bear case and where this could go wrong, because we're painting a picture of an invincible juggernaut here.
Fair enough. The geopolitical supply shock scenario we just discussed actually introduces a significant short-term risk.
Exactly. If there is a massive escalation or a Hormuz closure, yes, the underlying commodity price goes up. But it could easily spark an aggressive, market-wide sell-off. If the broader market panics, if inflation fears cause the S&P 500 to drop 10% in a week, ExxonMobil is going to get dragged down in that panic, regardless of how good their internal math is.
A rising tide lifts all boats, but a falling tide can sink them, at least temporarily.
Liquidity events spare no one.
That is a very real short-term vulnerability. However, the structural counterargument is that their fortress balance sheet and low break-evens provide a massive shock absorber against that volatility.
How so?
Well, even if the stock takes a sympathetic 30% dip alongside a broader market crash, their underlying cash generation remains virtually untouched. In fact, if the stock drops while their cash flow remains high, it simply allows them to execute that $20 billion buyback program at much cheaper valuations.
Oh, retiring even more shares.
Right, creating even greater long-term value for the people who hold through it.
Fair point on the financial engineering, but what about the legal and regulatory hurdles? There are ongoing lawsuits, specifically the highly publicized friction with the California Attorney General regarding environmental claims and allegations surrounding plastics recycling.
That's definitely making headlines.
We are looking at this purely from a market impact perspective, but drawn-out litigation over environmental deception claims can create serious headline risk and friction for the stock.
Headline risk is absolutely a factor. But when you look at the recent track record in the courts, we have seen several of these types of cases result in dismissals or drawn-out appeals that stretch for decades.
So the market just tunes it out.
The market has become incredibly efficient at digesting long-tail litigation. Because these challenges rarely result in immediate catastrophic cash flow impacts, institutional investors view them as highly manageable for a company of this size. The risk is already priced into the current neutral to bullish sentiment. It is not a surprise variable that will suddenly shock the street or derail the 2030 targets.
All right, bringing all the data together for the final verdict. We've got macro tailwinds, massive efficiencies, and manageable risks.
Based on the structural transformation, the massive cash flow generation, and the geopolitical positioning we've unpacked today, the definitive bullish score for ExxonMobil is a 9 out of 10.
Give me the final elevator pitch for you, the listener, who is weighing this multi-year investment thesis against the rest of the market.
The thesis comes down to unprecedented operational leverage. ExxonMobil is executing a historic transformation that locks in 13% annual earnings growth straight through to 2030. By doubling their Permian output, achieving $20 billion in permanent structural cost cuts, and absorbing Pioneer's premium acreage, they are on track to generate $35 billion in free cash flow upside.
And the technology advantage.
Yes, their proprietary lightweight proppant tech gives them an ironclad competitive moat in extraction efficiency. When you combine that execution with a 0.56x debt ratio, 39% six-month momentum, and institutional safe haven flows, this is far more than a short-term geopolitical trade. It is a premium multi-year hold designed to compound wealth into the 2030 milestones.
I want to leave you with a final provocative thought to ponder on your own. We have spent this time analyzing how perfectly positioned ExxonMobil is to generate massive cash and efficiency during this specific period of geopolitical chaos. But what happens to their capital allocation strategy if global energy markets suddenly stabilize?
That's the real question.
If the conflicts resolve, supply chains normalize, and oil prices settle, they are still going to be generating mountains of cash thanks to those permanent structural efficiencies. Do they simply become an even bigger dividend giant, returning unprecedented yields to shareholders? Or do they use that massive unlevered war chest to pivot entirely?
They could buy almost anything.
Could they start acquiring entirely new energy sectors, completely dominating the next wave of global infrastructure? The optionality they have engineered for themselves is fascinating to watch.
The financial flexibility they have built means they get to dictate their own future, rather than just reacting to the market.
That wraps up our analysis for today. As a final reminder, make sure you subscribe, like, and comment to support the channel. It really helps us bring you more of these deep analytical breakdowns. Thanks for listening, and we will see you next time.